Futures still under pressure coming off of yesterday's wipeout. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Now coming up, wait and see mode. Investors assess the escalating crisis in the Middle East as well as fresh data ahead of Friday's much anticipated jobs report. Also, Nike's reset, shares falling as the sportswear giant withdraws its guidance after sales missed estimates. Plus, an exclusive conversation with Emmanuel Macron. The French president speaks to Bloomberg about Europe's evolving role in a multipolar world. All that and more coming up, but let's take a look at where markets are trading 30 minutes until the bells ring. You can see the S&P 500 under pressure pre-market. Of course, we got stronger than expected ADP just a little while ago. Not really making much of a dent, of course. Still anxiety out there about what's going on in the Middle East. We'll get to that, but you can see that reflected in the NASDAQ 100 as well. Currently down about 0.1% on your big tech index. Meanwhile, you're not seeing a haven bid in the bond market. That's interesting. You take a look at the 10-year Treasury yield, reversing some of the gains that we saw yesterday. Yields currently up almost 7 basis points, Sonali.
Let's take a look under the hood here. Some of the stocks to watch, as you've been talking about, Nike withdrew its full-year guidance in an effort to reset expectations. That's as Elliott Hill prepares to take over as CEO. You have Nike shares still down, though, more than 7% pre-market. I'm also watching shares of Humana just plunging after seeing a significant drop in membership enrollment for its Medicare Advantage program. This drop in Humana of more than 20% pre-market could be the worst you've seen in more than a dozen years. We'll keep an eye on that throughout the show as well. LPL Financial had abruptly fired its CEO Dan Arnold for violating the firm's code of conduct to maintain a respectful workplace, and it's deeming him ineligible for severance. Yet remember, Dan Arnold, you had the stock rise every year since he's taken over. Now operating with an interim CM, you have LPL down almost 3% pre-market, Katie.
All right, let's also take a look at shares of some Chinese-listed stocks surging on growing optimism over the government's stimulus plan. You have China stocks outperforming their global peers in recent weeks. We aren't necessarily getting new news when it comes to Chinese stimulus. Of course, mainland China currently shut for a holiday, but you did have Chinese shares listed in Hong Kong really surge last night. And I don't know, Sonali, when it comes to this big rally that we're seeing in China, I wonder how much you can really trust it. We've been here before. Think about 2022, for example. That reopening bet was the consensus trade. It didn't work out too well.
You've been asking so much about the spillover into U.S. equities. Well, maybe here's one. We have Tesla deliveries now coming in at 462, almost 463,000. The estimate was just about that. It is slightly lower than estimates, but you do have an increase relative to what we have seen from Tesla prior in the year. Actually, let's bring in Bloomberg's Ed Ludlow now, because China is a large part of that story. How are investors going to digest this?
Well, the stock's fallen to pre-market session lows. Overall, the third quarter numbers miss street expectations. It's always important to emphasize that it is consensus or the average of sell-side estimates. You should break down the data in as far as you can. So if you look at 3 and Y, which is the only model line that they specifically break out, deliveries were about 440,000 above estimates, but it was kind of that other bucket that came in weaker. And you're right to point to China, because there was hope that China would be a bright spot here. There have been government subsidies, basically a trade-in policy, where the China-specific data, the government or third-party data, did show some strength. So the market's punishing Tesla a bit for missing sell-side estimates. But as you guys know, this is a name where the business of delivering cars to consumers is kind of in the rearview mirror, and the future's about a very different business model.
Yeah, you're right there, Ed. Tesla shares currently down about 2.5% pre-market. Of course, after those deliveries, those third quarter deliveries, missed estimates a little bit. And I'm hoping you can disentangle for us how much of this, of course, disappointment is Tesla specific versus industry specific, because we hear all the time about EV demand not being as robust as a lot of these automakers had expected.
Yeah, I mean, I'm looking at the stock. We're down now 2.7%, 2.6% in the pre-market. I guess the expectations are high in the sense that consumer sentiment may have adjusted to electric vehicles, in the sense that higher rates in a higher rate environment were putting consumers off. Now, we've had slightly incremental moves lower by central banks around the world, that isn't going to suddenly send consumers flying to lease or finance new vehicles. But it can always have a psychological effect. You have to look into specific markets, and take delivery numbers in aggregate. In Tesla's case, it's funny because, again, I reiterate the breakdown of the data insofar as we've got it. 3 and Y in that basket of the higher volume selling cars beat estimates. Everything else, which is XS, Cybertruck, which is a strange one, maybe we can chat about, and then Semi missed estimates. Usually you wouldn't linger on that latter bucket. Maybe hopes are really high for Cybertruck, which you see a lot more of on the roads at the moment in North America.
All right, Ed, really appreciate that. Of course, Tesla shares still under pressure, currently down about 2.5%. Of course, third quarter deliveries coming in a little bit lighter than expected. You can catch Ed on Bloomberg Technology right after this show. But let's stick here and let's pivot to politics, because last night, J.D. Vance and Tim Walz made their pitch to American voters at what is likely the last debate of the presidential election. Here are just some of the takeaways, starting with the geopolitical tensions that the next administration will inherit.
When our allies see Donald Trump turn towards Vladimir Putin, turn towards North Korea, when we start to see that type of fickleness around holding the coalitions together, we will stay committed. And as the vice president said today we will protect our forces and our allied forces, and there will be consequences.
As much as Governor Walz just accused Donald Trump of being an agent of chaos, Donald Trump actually delivered stability in the world, and he did it by establishing effective deterrence. One thing that Joe Biden did is he continued some of the Trump tariffs that protected American manufacturing jobs. And it's the one issue, the most pro-worker part of the Biden administration, it's the one issue where Kamala Harris has run away from Joe Biden's record plan, but it's also a record. A lot of those same economists attack Donald Trump's plans, and they have PhDs, but they don't have common sense and they don't have wisdom.
Well, Kamala Harris's day one was Donald Trump's failure on COVID that led to the collapse of our economy. We were already before COVID in a manufacturing recession, but 10 million people out of work, largest percentage since the Great Depression.
Let's now get the download with Bloomberg's Michael Shepard, who is a senior editor for us in Washington, D.C. Now, we know both candidates had grappled to address two major issues, and that's the toll of Hurricane Helene, which also happens to be in key swing states, as well as the Iranian missile attack on Israel. Should the candidates have gone further in speaking to the U.S. response?
Well, the way the questions were framed was on Helene around climate change. And this is one that Tim Walz was able to take and seize on and point to the Harris-Biden agenda, pointing to the Inflation Reduction Act. We were just talking with Ed Ludlow about electric vehicles, all the subsidies under that law aimed at encouraging Americans to transition over to electric power vehicles to reduce emissions. J.D. Vance, for his part, seized on the question in a different way, and he used it to fault Harris for failures in terms of failing to promote manufacturing and allowing China to gain ground in certain areas, including electric vehicle technology. At the same time, on Iran, we heard in the clip, when they were asked about it, Tim Walz used the moment to really frame the argument against Donald Trump, to once again say, continuing the Harris line, that the former president is unfit for another term and is not suited to lead the nation. And then J.D. Vance, as he took the question, he tried to point to Donald Trump as the most effective agent of deterrence the White House has had.
All right, Bloomberg's Mike Shepard in D.C. We appreciate your reporting. Let's broaden out this conversation now, because here at the desk we have Tony DeSpirito. He is BlackRock's global CIO of fundamental equities. It's great to see you again, Tony.
Great to be here.
So in addition to politics, of course, in addition to the economic data that we're getting, you, of course, have what's unfolding right now in the Middle East, those geopolitical tensions. And I know that you preach the power of compounding, staying investing. And with that in mind, how are you viewing, of course, geopolitical tensions? Do you hedge that, or do you look through it?
Sure. There's a short-term lens and a long-term lens. And if you think about the long-term lens, I mean, look over the last 50 years, the events we've gone through. A president resigning, stagflation, the 1987 stock market crash, the three Gulf wars in the Middle East, the global financial crisis, COVID, right? That's a long list of things to worry about. S&P, If you took $5,000 and invested it 50 years ago, you'd have $1.3 million today. So that's the power of compounding that we spoke about. In terms of what's going on today, I mean, certainly in the portfolio I run, the equity dividend fund, for example, we have overweights in defense stocks and in energy. And I think they're good investments in and of themselves, good free cash flow, good yield, et cetera. But they also, in times like these, help provide some resiliency to the portfolio. And so I think that's an important short-term hedge, if you will.
I want to also kind of broaden out to what's going on here in the United States as well, because of course you have a lot of tension in the Middle East. It did weigh on stocks, at least in the near term here yesterday into this morning. But you also had that ADP data that came in stronger than expected. So the American economy is holding up. You had yields rise marginally on the heels of that news. What does it mean if you still have the strong economic data and perhaps the Fed is not able to cut as much as expected? If oil prices, because of the geopolitical tension, stay higher than expected and those cuts just don't materialize because of the strong economy and potential inflation?
So I think we're at a really nice point in the cycle. If you look at the ADP number, 143,000 jobs, that's a very sustainable number. So if we continue at this pace, I think that's great news for the economy. Not too hot, not too cold. And I think the fundamentals in terms of the economy, in terms of company earnings, that matters a lot more than rates do.
Well, let's talk a little bit more about rates. It is interesting, of course, and striking to see the Fed cutting into strength and expected strength. We haven't really seen that before. There's not a lot of blueprints for that. So what playbook are you following here? Are you writing a new one for this Fed cutting cycle?
Well, one of the nice things about this cycle is the rate cuts aren't driven by fears of the economy going into recession. It's driven by the fact that the Fed has the luxury of cutting because inflation has come down quite nicely. And so we're seeing inflation very much at or very close to normalized levels that the Fed wants to see. And so I think about it as the Fed has a lot of stored power, right? Rates were 5.25%. They can bring them down pretty dramatically and keep this economy going. And so I think what we're seeing is kind of just normal mid-cycle activity. Now, normally in a rate cut, the factors and the sectors that work well, it's factor-wise, it's low beta stocks, high quality, large caps over small caps. Sector-wise, healthcare, staples tend to do very well. I think that's still a good playbook because when I look at the valuations of those sectors and those factors, they all look pretty good to me. And history tells you they have a high hit rate of working.
Tony, in the near term also, we still have, with the election, potential regulatory risk in certain sectors. I was really interested last night to hear healthcare come up as much as it had. That seems to be a bipartisan issue, the cost of healthcare. How do you really invest across the healthcare sector when there's that much risk in terms of pricing for Americans of ordinary drugs?
Yeah, so I actually think there's less risk this election than in prior ones. I mean, if you look at the presidential debate, there was very little talk about healthcare, actually. And so I think that's pretty good. In terms of when I look at kind of the elections and how they impact markets, typically not a lot of impact on the overall market. And obviously certain sectors more so, but in terms of the overall market, who wins doesn't really impact the long-term results of the market. One of the other interesting things we've seen in studying elections is often the initial reaction is the wrong reaction. Meaning if you look at the last 7 elections, 5 out of the last 7, if you take the results of the first month in terms of factors or sectors, over the next 11, they completely reversed. And I think that's the interesting result is that people tend to think, oh, there's going to be big policy change. The reality, never so much.
Yeah, and I think we all have painful memories of 2016, of course. You had the knee-jerk reaction, and then it completely reversed. I do want to get your thoughts on China, though. We were talking about this a little bit at the top, that obviously you've seen euphoria just unleashed in the Chinese market right now. Of course, the CSI 300 now in a bull market, even though, we were nursing losses just about a week or two ago. How are you thinking about China? How can you be sure that this is a sustainable, real rally that might actually have positive implications for the U.S. versus just another head fake?
Yeah, so as you know at BlackRock, or may know, we have a tactical overweight on China. And I think it's a matter of there are some long-term structural issues. But on the other hand, we do have a big amount of fiscal and monetary stimulus that just came out. And I think when you look at what happened in the market, it's really reflective of the fact that the starting point, the valuations were so low. So there was a really big gap, near record gap between developed market valuations and valuations in China. And valuation, I like to say, it never tells you when something's going to start to outperform, but it certainly tells you the magnitude or the potential magnitude of how much something can outperform. And I think that's what we've really seen, is just valuations coming off of really depressed levels.
All right, Tony, you're sticking with us. We're going to get into the nitty-gritty of U.S. earnings next. That is BlackRock's Tony DeSpirito. Let's quickly check back in on Tesla, though. Of course, getting those third quarter delivery numbers coming in a bit light overall. You can see that pressure reflected in Tesla pre-market right now, currently down by more than 3% right now. You take a look at what did well. It was Model 3. It was Model Y deliveries coming in a little bit heavier than expected, but other model deliveries coming up short. Meanwhile, we're going to take a look at what else is not doing too hot this morning. Nike withdrawing its full-year guidance as it prepares for new leadership. We'll take a look at the state of the swoosh next. This is Bloomberg. Welcome back to Bloomberg Open Interest. Let's take a look at how markets are faring before the bell, and there is red on this screen. You can see the S&P 500 down about 0.2%. It's a similar story if you take a look at big tech in the NASDAQ 100. Of course, those geopolitical fears still weighing over markets after what we saw in yesterday's session. We got hotter than expected ADP this morning. That's having quite a reaction in the bond market, not so much in stocks right now, as you can see, holding those losses. And the Russell 2000, your small caps, currently off about 0.6%, Sonali.
And we're going to bring back Tony DeSpirito, BlackRock Global CIO of Fundamental Equities. We've been talking about sectors before the break as well, and I want to go right to the consumer sector, because if employment seems to be holding up, we're waiting that all-important jobs data still, but the ADP was promising. You had that bid since the Fed rate cut into that consumer discretionary sector, but you're seeing a ton of divergence here. How do you think about the strength of the U.S. consumer in terms of how you invest in equities today?
Yeah, so a couple of things. One is when you look at sectors, I always look at dispersion within a sector, right? And consumer discretionary, it's not the highest, but it's towards the high end in terms of dispersion. And to your point, each company is very different. An auto manufacturer is very different from a consumer retailer, for example. The other thing that we see is certainly, high end versus low end consumer, a real disparity there. And the low end, has been struggling, right? Got a big boost during COVID, has worked off those COVID savings, and now is struggling. And so we definitely see that and look out for that. And then the other thing I would say is, it's a matter of earnings. And so as long as jobs stay strong, unemployment low, the consumer will continue to spend. And then we got some nice data revisions, right, in terms of personal savings rate, right? It had looked like it was extremely low. Based on the revisions, that's much more into the normal range now. So that gives me a lot more comfort when it comes to consumer spending. That good jobs, interest rates coming down, I think the consumer is still in good shape.
Well, you talk about revisions. It's going to be interesting to see what we get on Friday, of course. Those jobs numbers have been steadily revised down over the past several months. But I want to stick on earnings, and I want to talk about how you're viewing the market in terms of market cap tiers right now. There was an interesting note from Torsten Slok of Apollo earlier this week saying that 42% of companies in the Russell 2000 have negative earnings. Then you do that analysis over the S&P 500, it's just 6%. So when you're taking a look at earnings and you're applying it to this small cap rotation that people keep talking about, how choosy do you have to be?
So people keep asking about that small cap rotation, and I go right to the number you cited, that over 40% of the companies in the Russell 2000 index are unprofitable. And even then, when you exclude those companies, it still has a higher PE ratio than the S&P 500. What I think is the more interesting question is mega cap versus run-of-the-mill large cap. So if you look at the S&P 500, the weighted average market cap is actually pretty close to $1 trillion. And it's really driven by 6 companies. We have a couple of companies at $3 trillion, 6 at about $1 trillion or above. Once you exclude those 6, the weighted average market cap goes from nearly $1 trillion down to about $250 billion. Wow, that's a big difference, right? And when I think about it, a company with a $150 billion or $250 billion market cap, it's a lot easier, just the law of large numbers, it's a lot easier for that company to double in stock price than it is for a $3 trillion company. And so we've been calling for a broadening of the market for a while now. And one of the things that we saw in the third quarter was, indeed, we got a broadening of the market where the equal weighted index outperformed the cap weighted index. And that hadn't happened in a while. Over the long run, actually, the equally weighted index wins. And it's trading at a 25% discount to the cap weighted S&P 500.
There's another part of the consumer sector I kind of want to tangentially hinge on here, and that's housing. The reason is I took a look while we were talking on what the best performing consumer discretionary stock is. It's Mohawk Industries, of all things. Lululemon, Nike, all much lower on the year, but this is a company, Mohawk, that focuses on ceramics and tiling. And you see that consumer bid really come into the housing sector, but you're not seeing people buy houses yet. At what point does that become a trade that you like because you finally see activity really loosening up this market?
Yeah, so what I think is really the stored potential in the housing market is housing turnover. If you look at housing starts, they're a little depressed versus long-term history, but what's really depressed is turnover. And there are various ways to play that. One of the ways I like to play it is through title insurance, right? When you get a mortgage, you have to get title insurance. When you refi,
really
you get
hot
title
names
insurance.
over there, Tony.
Certainly very niche-y, but really interesting because it really benefits from turnover. And you don't care about housing prices, you don't care about margins on housing products, you just care about turnover. And that is the factor today that's most depressed. We need rates to come down a little bit more, and I think you'll really see an acceleration in the housing market.
All right, well, plenty of people say that's in the offing, so we'll have to keep a look at title insurance. Tony DeSpirito, it is great to see you. That, of course, is BlackRock's global CIO of fundamental equities. Meanwhile, let's take a look at Nike. The stock falling pre-market after the company missed on sales estimates. It withdrew its full-year sales guidance. This all coming ahead of new CEO Elliott Hill's arrival, giving him a clean slate. Here with more is Bloomberg's Kim Bastine, who, of course, covers the company. Okay, Kim, so they withdrew full-year guidance. They postponed their investor day. That's not necessarily surprising, and yet you see shares down by more than 7.5% pre-market. How do you explain this reaction?
What they're doing here is really resetting expectations for this incoming CEO, Elliott Hill. So he starts on October 14th, and right now they're in this transitional period in between. Like on that call with analysts for earnings, it was the CFO, Matt Friend, who was the only Nike executive addressing investors and analysts. John Donahoe, the previous CEO, wasn't even there, and they're just waiting for Elliott Hill to begin his tenure.
No, it's interesting, Kim. I was reading a note earlier today from Ashwat Damodaran, who is the Dean of Valuation, really, at NYU, very famous for that. He said at $71 a share, the stock price was in your favor for investing odds, and that boost in the stock price that went past $88 had really suggested the expectation for higher growth and better margins. How much pressure is on the new CEO to deliver that, given that the bounce has already been seen in the stock, frankly?
A lot of pressure, and at this point, this is the starting point for his turnaround, right? So this past quarter, analysts were saying they didn't really care about, it was so backwards looking because the status quo has changed so much since then. So what they're waiting for now is the new CEO's plan. They had planned an investor day in November, but they've now pushed that back to an unknown time as he prepares that turnaround strategy. So a few months from now, we'll find out.
Less than a minute here, but really quickly, I mean, we don't know the plan yet for Elliott Hill, but have to imagine it'll be reconnecting with retailers.
Yeah, so Nike went through this retail pullback from its retail partners in favor of its own stores and website. It was a direct-to-consumer strategy that seemed to go a little too far. So they're reconnecting with retailers like Foot Locker and rebuilding those relationships that they really set aside. There's also rebuilding relationships with employees who were having who had a lot of issues with their former CEO.
All right, Kim, great reporting as always on all things Nike. Our thanks to Bloomberg's Kim Bastine. Of course, Nike shares down 7.5% pre-market, down about 17% year to date. Meanwhile, we brought now to the broader market right now. Of course, 4 minutes before those opening bells ring, you can see the broader market is under pressure as well. The S&P 500, the NASDAQ 100 currently off by about 0.2%. The Russell 2000, your small caps, down 0.5%. We'll have all the coverage of the market open coming up next. This is Bloomberg. we are moments away from the start of trading, of course, on the second trading day of October, the second trading day of the fourth quarter. 18 seconds to go. This is Bloomberg Open Interest. I'm Katie Greifeld, and of course, following through on what we saw yesterday, of course, that geopolitical tension making itself known in the U.S. equity market, still under pressure this morning. And the question becomes whether or not this episode will be inflationary. Of course, you've seen the follow through in oil. You're seeing that in the energy names as well. And you were seeing it in the bond market. Of course, that haven bid now reversing after that stronger than expected ADP print that we got at 8:30 a.m. Let's take a look at where the major averages are trading. Of course, just a couple seconds into the trading day, you can see the S&P 500, the NASDAQ 100, your big tech stocks, both under pressure this morning on those indexes, down about 0.2 to 0.3%. It's the small caps that are your biggest losers so far today, down 0.3%. We'll see what happens between now and 4 p.m. Of course, maybe those dip buyers come in, but some stocks to keep an eye on under the surface. You have Nike trying to wipe the slate clean for incoming CEO Elliott Hill, pulling its full year sales guidance yesterday, of course, also announcing that it's postponing its investor day set for November. You can see shares still down about 7.5%, Sonali.
Also watching some more red tape. When you look at Humana, it reported a significant drop in membership enrollment for its Medicare Advantage program. It could impact revenue. Humana shares at the open down more than 21%. This could be the biggest drop in years. We'll keep an eye on it. Also watching shares of Tesla, shares down after the EV maker's third quarter deliveries slightly behind the average analyst estimate. You have Tesla shares down almost 5% at the open, Katie.
All right, let's pull back here and take a look at the broader markets. The reaction that we've seen, of course, to those geopolitical fears flaring up again. Bloomberg's Jess Menton joining us now. And Jess, it's striking. I mean, you think about past episodes of escalation, you didn't necessarily see it make a dent in the U.S. risk asset market. But still, today and yesterday, you saw it.
And especially because and you were just alluding to this, because it is the second trading day of the fourth quarter, and we just came off of the best first 9 months to a year since 1997, and the S&P 500 was already up around 20%. So when you have the S&P 500 trading around all-time highs, and then you have things like this happen, and especially when it's trading close to that 50-day moving average, a little bit of weakness there. And then especially with the VIX, I did a taking stock column this morning that looked at kind of what typically, because I think a lot of times October, a lot of people think it's a spooky month when you think about the stock market crashes of 1929 or 1987 or 2008, but it's not the worst month of the year. We know that actually September followed by August. It's actually
not
the most volatile. Exactly, not this year though, and it bucked the trend in September, and it was up about 2% last month. So actually, October is the most volatile month of the year by far, and it's about 34% higher when it comes to that volatility compared to other months.
I also want to bring in now what the sectors look like under the surface. Katie, almost every sector here is in the red this morning. There's one sector in the green, and that's energy. It's up by more than 1%, not surprising. Second day of gains here in Brent prices, New York crude. You are waiting, the market is awaiting to see what Israel's response will be to that Iranian ballistic missile attack. At the end of the day, with energy higher, what is the risk for stocks? The first thing you think about is inflation.
Exactly, but the Fed obviously has made it clear that they're more focused on the other side of their dual mandate when it comes to employment. And a lot of times when we've seen geopolitical conflicts, especially in the Middle East, a lot of times when you think about the energy producers in the U.S., for instance, yesterday when we saw that spike higher with crude prices, you saw companies like Exxon and Chevron and other big oil producers moving higher, because a lot of times in Europe, they're more dependent, and it's a little bit different when you think about how we're set up here in the U.S. So typically, you might see a particular spike there when it happens, but I don't think the Federal Reserve would be as concerned, because we don't know how exactly all this is going to play out. And especially when you're looking at the options market, they're still more concerned right now about when it comes to employment reports like on Friday versus, say, the CPI report later this month.
Yeah, it's a fair point there. And you think about what the Fed pays attention to, those core figures, for example. Energy, of course, doesn't factor in. But I am curious, you see energy up partly because people are hedging right now. That is their preferred way of hedging. And I'm curious, when you're talking to investors, to analysts about these risks that are out there, How are they choosing to hedge? Is it in the options market? Is it buying energy stocks? Is it going into the bond market right now?
Well, even if you look at the put-call ratio from SIPO, right now, even coming into this week, it was actually pretty low and a lot lower than you would expect if you're looking at the 5-day moving average right now. So coming into this week, if you're looking at how hedging was compared to the SPY, obviously the ETF that tracks the S&P 500, it wasn't as pricey as you would probably think it would be. So right now that tells you they're still not necessarily thinking that there are major risks. But of course, we still have a blitz of earnings season that are going to come October 11th. We'll have JP Morgan and the other banks reporting. You still have the election coming up on November 5th. And obviously 2 days later, you'll have the Federal Reserve decision. But right now, when you're looking at as far as what hedging is, it's not telling you that there's that much concern.
One more on inflation. I totally hear you guys on the energy point here, but you do still have a market that is pricing in at least 100 basis points worth of rate cuts through the beginning of January, at least, or the end of January, rather, right? So it's still significant. If you don't see those materialize to that degree, what does it mean for the stock market?
Well, when I've been speaking with portfolio managers, a lot of times, especially when you're talking about swaps, if there is more of that indication that they're leaning more towards 50 in the swaps market, but then even if you're thinking about central bankers, depending on if they're signaling maybe it might not be 50, just depends on what the data says, then you'd have to see that type of repricing, because if you think about the last meeting, obviously the swaps market was pricing in 50 basis points, and the Federal Reserve did that. You saw stocks bounce off of that. So it might be a little bit of a different play there, depending on whether or not you see how that shakes out. But obviously, it really depends on the data that comes out in the next few weeks.
And if you are trying to trace the indirect route where these energy price spikes that we're seeing factor into the Federal Reserve's decision making, it matters for inflation expectations. You're seeing break-evens rise right now. The Federal Reserve absolutely cares about that. But let's look under the hood here, because, of course, at the index level, we're down a little bit this morning. Tell us about what's going on with Apple, for example, and when we take a look at those individual names.
Right. So looking under the hood for Apple, it's actually down close to 1% right now. So you did see JP Morgan join Barclays as well as Citi as far as when it was downgrading a little bit of its outlook for when it was thinking about its iPhone unit sales. So it was coming in right now around 126 million units. It previously was 130 units compared to what they had that estimates prior. But also that stock's been up around 17% coming into today and for the year. And also it really had a first tough quarter that I think a lot of people forgot about, especially relative to the S&P 500. But it bottomed back in April and has been on a tear ever since. So when you see it pull back a little bit like that, it kind of makes sense to some technicians that I've been speaking with.
When we look under the hood, guys, today, there's kind of a lot of red on the screen and individual movers. We've been talking a lot about the single stock volatility. I also want to bring you to ConAgra here, because you do see it down roughly 7% as the market opens, more than that now. What are the issues?
Right. So this is especially a key space when you're thinking about consumer packaged good companies and what that means for price to mix, because Jen Partashis over at Bloomberg Intelligence has talked a lot about these types of companies, because right now their fiscal first quarter, their profit and sales outlook wasn't as strong as investors were anticipating. And a lot of these companies have had that margin pain just because they continue to have to pass on a lot of those costs due to inflation. And then once again, it did blame those types of inflation issues too. So when you're looking at that, and also not even just ConAgra, but if you're looking over at what's happening with other companies that are in the consumer packaged goods space in the S&P 500, that index is actually down a little bit more than 1%. So obviously not just ConAgra, but other consumer packaged good companies falling on the back of this report as well.
And we're watching that, of course, materialize, that drop that you're speaking about. Tell me about Home Depot, of course, today. Some sell-side action going on and potentially weighing on the stock here a little bit.
And you know, right now, you're seeing it down about 0.6%, but actually it was upgraded to a buy rating at Gordon Haskett. So they actually see potential improvement here in the home improvement type space, just on the back of where we're just talking about the Federal Reserve cutting rates, what that could mean for the mortgage space. But it's been interesting when you think about Home Depot as well as Lowe's, because they are a little bit of a different story. Usually Lowe's is more of kind of a DIY type of kind of project type thing. We saw a lot of that during the depths of the pandemic. But when it comes to Home Depot, and especially with those types of stocks, a lot of that also has been just because those two companies are in the discretionary space. And those two, like discretionary as well as tech, were hit the hardest yesterday because they're more of the growth kind of corners of the market. So I think that's more of kind of it's being kind of holding back those gains, even though it had more of an optimistic rating here.
Yeah, it's a great point. Of course, Home Depot up mightily year to date, but a lot of question marks that are forming over the discretionary space. Jess Menton, it's always great to see you. That is Bloomberg's Jess Menton. Meanwhile, let's take a look at these broader markets right now, still under pressure, actually deepening losses right now. If you take a look at the S&P 500, at the NASDAQ 100, both down about 0.4%. Not really many bright spots to find in this market, especially if you take a look at the Russell 2000. That was your biggest loser on the day, but still off about 0.3%. Mild outperformance if you want to be optimistic, Sonali.
We were talking about most sectors in the red, but I also want to talk about some individual stocks, particularly Humana. The drop is the most since you've seen since February of 2009 at more than 22% lower at the open. There are worries building about Medicare revenue on top of previous worries about costs and tighter reimbursements. We'll keep an eye on that as the day goes. This is Bloomberg.
All right, welcome back to Bloomberg Open Interest. Let's go now to an exclusive conversation with French President Emmanuel Macron, speaking with Bloomberg's Stephanie Flanders in Berlin.
And thank you for organizing this event. Look, I hope the maximum number of items, because I really believe that we are at risk, to be honest. And it's just a word. I think our own model was completely changed and has to be reset. And when you look at the European model, largely based, by the way, on the strengths of Germany during the past decade, we were based on exports and a big part of the key industry, car making industry, to China. We were based on low-cost energy, Russian gas. We were based on defense umbrella from the US, without any question. And everything now is shaken. China has overcapacities and is clearly a competitive place. So it's no more a secured place for our exports. Russian war killed low-cost energy, and the killer of our competitiveness today is a big gap in terms of energy prices everywhere. This is why we have to completely change our business and have an integrated energy model, because we can deliver with nuclear and renewables, but not without being integrated. And very clearly, post Afghanistan, some people can have doubt, and the potential change in leadership in the US means that this is not a guarantee total. So I want to insist on that, because it's super important to assess fairly the fact that our former model is over. And this is not a question of adjustment. This is not the same world, 2024, 2025. And on top of that, we are making the same mistakes on top of the key elements I mentioned. We are over-regulating and under-investing. So just if in the 2 to 3 years to come, if we follow our classical agenda, we will be out of the market, I have no doubt. So I think what we have to deliver in the 2 to 3 years to come is capital market union. My view is that we have to rush on energy beyond what we already decided, which will be implemented for 2026, which will avoid the big peak and the instability of the energy market we had during the past few years. We corrected that, but we have to go much faster and further. And we need this investment shock I mentioned. And I think the simplification agenda and let's say, pause in terms of regulation, but even deregulation in some issues, it's absolutely critical.
Can you have any investment? Can you have that investment shock without issuance of joint debt?
I think, the best way to deliver is not to create big trauma at the beginning, by experience.
But you persuaded the Germans before. Can't you do it again?
This is true, but I was. If I want to be fair, I was a little bit helped by a colleague called COVID-19, and it changed the reality. But what I think we have an external systemic shock. I think we have to assess that. During the pandemic, we all experienced a symmetric shock for all our economies. And this is why we made this move with Chancellor Merkel. And I think it was a unique move, and this is really a for me, a fundamental change of our EU. Now, I want us to be totally aware of the fact that we are living a symmetric shock on our economies whose scale and magnitude is underestimated. Because the reallocation factor is huge. Look at the chemical industry in Europe, completely being reallocated because of IRA, I mentioned. If you don't deliver the level playing field agenda, we will be super happy with REACH as a good regulation for European consumer, but for no more existing chemical industry. And it will be the same for steel. It will be the same for, the existing business we have because of energy costs and over-regulation. So we have to fix energy issue and over-regulation. And for me, single market on energy, and on top of that, diversification of our furnishers to reduce this discrepancy, and acceleration of level playing field agenda and pause in terms of regulation. It's critical. And if we don't have the level playing field agenda, we will be killed in this market. And in parallel, for clean energy and artificial intelligence, we have to invest much more rapidly and protect as well our key players. Otherwise, they will be reallocated in the US.
Lars Henrik, I mentioned the joint debt question, but actually there's a broader issue here that you listen to President Macron, you read the Draghi report, you read many speeches, frankly, from European leaders, but not from the German Chancellor, not from German leaders, assessing the threat to the growth model as fundamentally as this, in the stark language that President Macron has used. If looking on the outside, how does Europe move forward, rush forward on this agenda if there isn't that understanding, that same analysis at the top in Germany?
I'm not sure that you don't share the analysis with the Chancellor Scholz. Obviously, he's a different person. But I think the analysis that we need simplification, what you were just saying, we need more investment, we have less regulation. I think that is something which, the Chancellery also says. I think that's a fundamental issue. I think capital market union, as I said, is an important step. But in the end, and he has been a remarkable European. I remember when you first came, you were actually a Sherpa for a while, if I may say that.
You were both Sherpas together, right?
Yeah, but he has moved on a lot since then.
I don't think you should feel bad. I think it's okay.
And of course, there's a reason why he's moved on. And so he came on stage and he said, "We want Europe," and you give your speech. And there was a debate whether Germany was responding appropriate to the young French president who was doing that. But I think he was always this good European, and I think we're very lucky to have him actually as a European. Also, if you think about the latest developments in your country, if I may say so, Mr. President, and also in our country. And I think the ultimate problem always in the end, and you alluded to that in the previous round on AI, the DeSpirito or the European industrial policy, is that there's still no European answer to many of these things. And if, in industrial policy and deregulation, and Draghi report makes that point. And is Europe really ready to give more power? You always also talked a lot about the governance of Europe and the way we are organized with Commission and Council and very powerful national leaders. And that is a fundamental issue, which I think makes it very difficult. But I think this is something which, in the end, is going to be, again, a very important issue. So I think that is something which is... But I think that the Draghi reports on the common debt, this is where I was getting here. I think, if I may say that, and you're closer, of course, than I am, I don't think the problem is not the common debt per se, but I think is that you want to make sure that the money is spent properly and there's no moral hazard with it. We discussed this a long time, many times. So I think it requires also certain governance. For example, you think about the defense union. I think if you want common debt on the defense union, you also need competences at the European level, because you have to have the decision power and the debt really hand in hand. So I think the common debt is easier once you give more of the governance also to the European level. But that's really a difficult issue. So I would, and I think this is an ongoing process, but I think what you're saying makes sense. But I think in the end, the big disadvantage of Europe is really, I'd be interested in what you think, is that we really don't have in many of these areas this European vision, which of anybody has actually. He does, yes. But it's not easy in Europe, and even if I may say so, if Germany and France, you said on Capital Market Union in Meseberg, you have a paper, which took us, I think, 10 years or something to get a French and a German position on that. Then the question is also, is the rest of Europe going to fall in line? That's also an interesting question, because they're getting more competent and more confident as well. So the leadership of Germany and France is very, very important. I think it's the only way actually to move Europe forward. I think that's also your view. But are the others then also in the future more likely to fall in line in terms of moving Europe forward? Those are...
Can we move on, just because you have, maybe it took 10 years to have Franco-German agreement on that, but we've only got a few days to have Franco-German agreement on the tariffs on Chinese electrical vehicles, and you mentioned it in your speech. On this stage a year ago, actually, I spoke to Chancellor Scholz, who said he didn't want to see a trade war with China. Mm-hmm. He didn't like tariffs. His minister earlier said something quite similar. But there is a vote on whether those tariffs go through on Friday. So can I just ask, do you think that will pass, that the EU governments will confirm those tariffs?
I don't know before the vote. I can tell you that I do support the European Commission on that. Because what are we speaking about? Electrical vehicles on the European market. And what is the reality? You have the European car makers, they go to the market, and by the way, we use our taxpayers' money to subsidize the consumer to buy these cars. And they have to compete with some car makers producing in China with an existing advantage, but it's part of the offshoring production because they produce in much lower cost condition. But on top of that, they benefit from subsidies from the Chinese government. This is a bias for your market. I think this is, the question is, which model do you choose? Do you want to be a consumer or a producer? And now this is the dilemma we have. 20 years ago, for solar panels, we decided to kill our markets. And we had the same dilemma. We did choose. We killed our industry. We had an existing industry, we killed it. And we deployed solar panels in a lot of places, Chinese ones. So we created a dependency, which could create some problem. We experienced that in COVID time. And we killed the ability to produce on the European soil. It's not a good idea when you need growth and you have to finance such a social model as the one we have. Now the question is, do we want a fair competition or not? I do want a fair competition. So the EU Commission launched precisely a series of studies, exchange with all the car makers, and just correct the level of discrepancies to re-establish the level playing field. So you have something from 9 to 10 for those who are less helped, and I think the range is between 21% and 35% tariffs for these car makers, but with evidence and figures which could be which were exchanged with the car makers and will be exchanged with the Chinese industry. We already have retaliation, by the way. I can speak with a clear view because it's on cognac. Nothing to deal with the cars. And I can tell you that cognac was never held by the French government. So, which means it is a pure retaliation. But this is a matter of credibility for our market. And I insist on that. If you don't preserve the level playing field, just don't hope that you want to produce and preserve your industrial footprint in Europe.
You spoke to Chancellor Scholz earlier. Did you make progress? Unfortunately, you didn't even have any advisors in the room, and the reporters were unable. There's no chance of us finding out. So I promised I'd ask you.
I do respect all the positions and the sensitivity of the market. I think the question is, what will become the Chinese market for the car makers. My view is that it did change during the past few years, and it should not be underestimated. This market is not just a market open to our car makers. You can deploy through GVs, good operations, but this is much more competitive than it was a few years ago. Chinese car makers are super competitive, and sometimes better than we are. And this is a market in overcapacities. And if we don't protect, but just restore the condition of level playing field, we will be the adjustment zone of the overcapacities, because the US just put a 100% tax, 100% tax undifferentiated. So let's wake up. We live in the same world. You cannot have China over-subsidizing, a lot of countries, even India and others, reacting to these subsidies, the US overreacting by 100% tariff, and Europe saying, you are welcome. I mean, it doesn't fly. Otherwise, we will be happy consumers of non-European producers. I can tell you, we will have an issue of growth in a few years' time.
How important is it to have Europe? You spoke about the importance of Europe speaking with one voice. In order to get one voice on this, would you agree to a delay or some kind of compromise, or you think?
I want to be efficient and find compromise and respect all the positions. I think I want to advocate the EU Commission. They did a great job. It was bold to do so, honestly, because they had a lot of pressure not to do it. And in the DNA of the Commission, you know that you worked there, Lars Hendrik, during years, it was not in the DNA of the European Commission to work on this type of issue. And I think it's, for me, this is a signal that clearly we have a much more strategic and geostrategic Commission, as we wanted, than before. But clearly, I want to insist on that. We are not just a market of consumers. And we were used just to behave following this line. And this is not a good idea. And we will have exactly the same issue on steel industry. I believe that on steel industry, we are much more aligned with the Chancellor and Germany. I'm sure that on Capital Market Union, simplification, we are very much aligned. So I want to insist on the fact that there is a very strong Franco-German alignment. Mm-hmm. Here is an issue very sensitive for some key players in your country, what I do respect. So the work has to be finalized with the European Commission, and I'm optimistic. But today, and Lars Hendrik was right to mention it, we worked very hard with Chancellor Scholz on these issues, and I mean, he is very much aligned on Capital Market Union, simplification, ability to invest much more public and private money, and as well being much more reactive to protect our steel industry or our chemical industry. So you have a strong Franco-German alignment at that.
You talked about protectionism as an ugly word, and that it's about having a different a more realistic strategic vision, as the US does, and certainly as China does. I wonder if, at the same time as having these tariffs for a level playing field, if you were to support, for example, finally moving ahead with Mercosur, would that send a message to other parts of the world that Europe is still open for business, that this is a specific thing with China, but actually Europe is still very much open to trade deals?
I'm in favor of any deal which will be fair.
Does it look fair right now?
Why? Because exactly the same reason, level playing field. You cannot impose a bunch of regulation to your industries and your farmers that they are digesting, by the way, because it's not yet completed, and at the same time open to economies totally disaligned with this regulation. How do you want to explain to a farmer that he will not be allowed to use this pesticide, this chemical ingredient and so on, and at the same time, on his sector, you say, you are more than welcome. You can come with your food without respecting the same rule. Honestly, I never advocate a regulation that I don't understand myself. And I think this is a good rule. And don't be naive. You speak about Mercosur. Brazil just imposed tariffs for EVs as well, and in the car system. They want to exclude public procurement from the deal. They protect themselves. They protect their economies. And my point is just, I think, a lot of people in Europe underestimated what happened during the past 2 to 3 years. But we had 2 huge shocks which could completely change our approach. IRA and war in Ukraine. The end of our energetical model and the end of the WTO order. I love Ngozi. I'm a strong advocate of WTO. Understand me? But just for the first time in our recent history, the US decided not to be compliant with WTO for clean tech. But this is too huge change. If we stay and stick to the same policy, we have no chance. And just look at the reallocation of so many industries, so many parts of our industries.
Just to follow up briefly on Mercosur, because after you saw him, I think Chancellor Scholz gave a speech today where he was proposing a sort of Mercosur light, the EU-specific bit of Mercosur, which doesn't involve some of the investment guarantees and things which involve government needing to all agree. So I just wondered, is that something that you would support, or would you be resigned to that happening
I'm not sure
without
to perfectly understand.
It is the bit of the Mercosur deal that has been negotiated that only involves, I think Lars Henrik will be an expert, you can explain.
No, I think he understands.
Well, I can only continue to explain.
He's strategically not understanding. Yeah.
I can be very clear.
I'm afraid to understand.
Well, the truth is, it could happen without you. That's
no, but I'm in
no,
favor.
No, it cannot. There's a, sorry.
This is a way.
All these trade deals have an EU part, EU-only part, and then they have something, usually investment, which is national. That has to be approved by all national governments. Yes. And if you split this and just do the EU part, it only has to be ratified by the European Council. But of course, France is in the European Council, and without France, it's not going to be ratified. So if he doesn't agree, it won't happen.
Why is your Chancellor suggesting today that you just move ahead with the EU, knowing that President Macron feels this way?
Well, he still has to work with France, obviously, even if it's EU only, but he will avoid going through all the national parliaments.
But
you know that.
Yeah,
right?
yeah, I'm in favor. We negotiated and even ratified a lot of trade deals during the past few years. CETA with Canada, with Chile, New Zealand, and some others. And these ones are good examples of those where we integrated the climate change issue. Because Paris Agreement, if you implement it, and this is what we decided to do, and I think we are right, is sustainable if you use the fact that you have, we don't use our capacity to put pressure on our partners, given the fact that we are a market of more than 400 million consumers. But if you decide to push your producers to make a move to be compliant with Paris Agreement, which I do support, we have to do 2 things at the same time, not just constraints with milestones and new regulation. You have to invest to help them, companies or households, and to make the change acceptable and to preserve precisely part of their competitiveness. And at the same time, you have to use that to make it a strategic instrument of your industrial policy. Otherwise, you have always to choose between climate sovereignty and industry. You can reconcile them if you are ready to use it as a bargaining power. Don't you think that countries are interested to have better access to the European market? For sure. It's an instrument to create incentives for them to be compliant and have the same level of regulation than we have on these key issues. Otherwise, I can tell you, in the years to come, you will have a majority to stop with the climate change agenda, and people will dismantle the carbon neutrality agenda. For sure. Because it is not compatible. And I'm sorry to say that, but in Mercosur, it seems you have Argentina. When I hear the president, I have good relation with President Milei. But I don't hear somebody who is totally convinced by the climate agenda and wants to deliver. Matter of fact. And 2 years ago in Brazil, we had a complete a skeptical guy on climate change. This is matter of fact. So I'm totally in favor of trade. I think we live in an open world. It provided a lot of growth during decades in our economy. I think it's part of the change of our own DNA. Just wake up. Both US and China, they do protect their market. They do subsidize their economy. They do invest much more than we do, both public and private innovation. So we have to adapt ourselves.
One of the big features of your presidency in the first few years, President Macron, was that strength at home gave you strength in Europe. You made decisive reforms, the employment, many other things. You got the fiscal house in order, and that gave you the power to push things through. I think many people here will be looking at what has happened in the last few months in France, the fragility of the new government under Monsieur Barnier, and wondering whether you still have that capacity to push through change. Do you worry that it was a mistake to call that election?
No, I don't think so. Why? Because it never happened without a cohabitation in France to be re-elected. So I'm very lucid about my situation. And we had a relative majority without any partners. So I called for snap elections for this reason after a little bit more than 2 years, where we delivered. I mean, during the past 2 years, we delivered a reform of indemnification of unemployed people, a pension scheme reform, an immigration reform. I mean, when I look around in Europe, I don't see a lot of countries deploying such a reform agenda. So we were under pressure, and I was very clear on the fact that when you have the far right more than 35%, you cannot follow up during 3 years to come, because I had 3 years to come, without making a move. But I think you should not see that as a source of instability. The reaction of the French people was the opposite. Because if they had confirmed the 35% for the far right, and what a lot of people thought, I would have a far-rightist prime minister today. It's not the case. So what we had for the first time in our history, which is much more the custom in your country and in a lot of European countries, is a fragmented parliament. Fine. This is less our culture to have cooperation between the parties. This is my problem. So I'm trying to create this dialectic work between the parties to work together. It's not a natural move, but I'm reasonably optimistic about the fact that reasonable social democrats, centrists, and reasonable rightists can work together for the years to come to deliver a strong agenda. And what we have to do is first to preserve and digest all the reforms we delivered during the past 7 years. And we have to deliver more for our young people. We have to complete what we did on apprenticeship to have a better and faster access to the market. It's one of the key points for the French system to have more growth. We have to follow up what we did on the unemployment system. We have to work on the access to our labor market for senior workers. And we have a lot of sectorial reform to be launched. We have, in France, this is our chance, the ability, even with a relative majority, to deliver these reforms at the Parliament. But I think we can create dynamic, and I do trust Mr. Barnier's government to be in this situation to deliver useful reform for the countries, because the agenda is quite clear. We have to modernize the country to be part of this agenda. We have to deliver at the European scale, and at the same time, we have to make more effort on social cohesion and stability of the country. This is normal in the lifetime of the country after 7 years. So I'm totally lucid about that and optimistic. But I want to focus on the fact that today, the key points of the reform agenda for me is at the European scale. I think we put in place a lot of reforms that now we have to deliver, and we have to deliver in concrete terms. We have less laws to be passed. And for instance, the pension scheme is for the years to come, and it's already voted. But the key elements are to be decided at the European scale. And I think if we want to improve our growth, both in Germany and France, for me, the top of my priority are the European scale. So this is a sort of reverse agenda if you compare with 2017, 2020, is that today we have to focus much more on how to simplify at the European scale, how to accelerate on the energy market, how to accelerate our financial services at the European scale. So I will dedicate much more energy at this scale because this is where we can unlock a lot of growth and potential.
But Lance-Henrik, when you have a country coming to these discussions that has a 6% of GDP budget deficit, as France now has, 110% debt, is having to have an extended period to get back within the convergence criteria, that is not a strong negotiating position.
You mean that country has
that country being France?
I don't think that negotiation position of France depends on the budget deficit. I think there's more to that than just that one. And I think that the European rules, I think, on the deficit criterion, which have been adjusted, actually are, as the minister was saying yesterday, very much in line actually with the German debt rule. So there's not that much difference here. And I think it should be applied. And I think, you know, I think generally there's a question of debt in the world. I mean, even you look at the US economy, they're very much, you know, over-debted. And if you look at both sides of the aisle, all of it is more spend, lower taxes, more subsidies in some cases, tariffs, which are also not going to necessarily increase growth. So I think the problem of debt in the world, I think, is an issue. And I think Europe needs to be careful of you know, having prudent fiscal rules and stimulus, and I think that's important. But I think I agree with President Macron that it is much more of a European issue. I think the future of Europe than it is a domestic French one, as he has done a lot of the reforms when he became president. I think labor market reforms, many of the things you have done. I don't, you know, and I think the regulatory issues are more important than the debt issues.
I mean,
just to highlight the point and make it clear, why are we in this situation? We had an issue during the low growth this year, so we have less return on our budget in terms of taxes. This is why we have this discrepancy with the forecast, and we had a difference in terms of forecast with some public expenditure at the local level. But more than that, to understand the French metrics, we started to diverge in the 80s because we built progressively a much more generous social model. The main factor of adjustment, if you take our balance sheet, I would say, is clearly pension reforms and healthcare system. This is a big bunch of where we have discrepancies, and especially as well because in terms of public expenditure, we have a social model where it's 100% through the budget of all the public administrations. This is why it was a necessity to pass this pension reform. And I mean, the figures and the negotiation we'll see, but probably in the next mandate, my successor will have to pass another one if they want to adjust. But the main focus, and I put my energy on one point, how to create more activity. Because why did we accumulate so many deficits and debt in the French model? This is because we never fixed the mass unemployment. And during the past 7 years, because of our tax reforms, because our labor laws reforms, because our attractiveness agenda, we've been the #1 country in terms of attractiveness during the past 5 years. We created more than 2 million jobs when we decreased, even with COVID, even with Ukraine, by more than 2 points our unemployment rate. Mm-hmm. So we are reconverging, and for me this is the main topic, because if we had the same level of activity as Germany, we will not have public deficit. And it's much smarter to work on that than being obsessed by a short-term adjustment, which is a killer for growth. The top priority of the French economy should be how to be sure that we improve the activity rate of young people, because we have, I think, 2 to 3 points less than Germany. Your system is more efficient. When I was elected, we had 250,000 apprentices per year. We have 900,000. we are converging with the German model. We still have some work to be done at the university to better allocate the offer of training, but this is a priority. Second, reducing unemployment rate again, because we are not yet at the German level, so we have to continue the reforms, and improve the rate of access and of activity of senior workers, because we have 2 to 3 points less than Germany as well. And part of the explanation of this point is the fact that we have not the same retirement age. So the key drivers are these ones. Let's be clear. So yes, you need political courage, and you have to be fair with your people, but the solution is not to have a short-term adjustment by cutting some social expenditure because it's super hard without any agenda, or overtaxing because we don't have a lot of room to maneuver in terms of taxation, given the fact that we are number 1 or 2. It depends with Denmark in Europe. Here's the agenda.
I mean, the cuts that are being proposed, we heard them a little bit today, that just for next year, to make Monsieur Barnier's numbers add up, we have a squeezing of the deficit by 60 billion euros
exactly
next year, some of which would be taxes on wealthy individuals and big businesses. Are any higher taxes that you would support?
They will discuss that. I think having an exceptional taxation on corporate is something which is well understood by large companies, if this is for 1 year, given the level of effort which should be made. But it should be limited, and we don't have to forget, I mean, we have not to forget the reality of our economy, the reality of our competitiveness and our position. Just take an OECD comparison. We are number 1 or 2 in terms of taxation. We are not in the best tier in terms of level of activity and how working participation or hours to be worked per year. So this is what we have to improve, let's be clear.
But as you say, the most important things that you can do for the long term is the reforms like the pension reform. That is another reason why people worry. They look at the cost of the uncertainty of the last few months, and you say that the far-right threat has been contained with this new arrangement, but Marine Le Pen wants to reverse that pension reform, and tomorrow she could call a confidence vote and probably bring down the government over that. So do you think that there will be opposition, will be an effort to overturn the pension reform?
I think when you look at the figures and you are sincere with people, all the reasonable parties will look at the fact that this pension reform and these key metrics has to be preserved. And we have a structure with all our unions, and this structure now is very clear and issued figures that it was a necessity to do so. And after a dissolution, you cannot change the parliament during at least 1 year time. But what I want to tell you is that first, I ask the reality and the pricing of uncertainty by calling for these snap elections. If I did not ask for this election, I could be in front of you and you would tell me, okay, you cannot go you cannot go for election in 2.5 years. Look at the scores; they are here, and they were in a situation to call for a confidence vote and force me for a dissolution, and I would have no answer. Now, we were bold collectively. I took my responsibility. I asked the French people, "Do you want them to govern?" They answered very clearly, "No." 11 million of my people did vote for them. So it means that there is anger, fears, and clearly some top priorities that we have to face on security, on social justice on the ground, the situation of poor neighborhood and so on, rural areas and so on. So this is the agenda we will have to fix and that the government has in front of him. But they didn't give the floor to them. And look at the situation everywhere in Europe. Look at what happened in Austria. Look at what happened in Netherlands. Look at what happened in Italy. Look at what's happening in a lot of lenders in your country. So this is why I'm a strong advocate of an EU growth agenda, because this is the only way to give a return to our middle classes. Or otherwise, this is a killer for them. And this is the only way to reconcile economy and the reality of politics. But don't you think that having farmers to which you ask for reforms and efforts, and at the same time you explain, I will welcome the soya bean coming from Mercosur, is the best way to kill the far right. I can tell you for my country, not at all. And at the end of the day, do you think what is the priority today for all of us? Delivering growth and political stability, meaning fixing this anxiety of our societies and convincing reasonable people in our middle classes not to go to the extremes. But let's be clear, didn't we deliver collectively good policies for our middle classes? During decades, we delivered good policies to have the maximum of exports, the maximum of profits, but they have the feeling, sometimes for good reasons, they were the adjustment factor of our economy. This is why preserving level playing field is not just sacrificing a lot of pieces of our economy where these middle classes work. I try to be consistent.
You've been very clear. I want to get on to a question from some of the young people here, but just to very quickly follow on from that, because you have defended very clearly why you took that decision to call the election in the summer. And at the time you said it was for clarity, and I guess some people would say you didn't get the clarity, but would you make the same decision again?
Yes, because
But in the next 2 years?
My view is that we have to preserve now till the end of my mandate. But it's important because this is a new phase of the political modernization of France as well. I was elected in 2017 in this commitment precisely to go beyond the party system. And I gathered with me people coming from the left, the right, and the center on a common project. And now the question is how to work collectively with not just my party, but other parties. This is a new way to move forward at the parliament. But this is a very positive one for me. And this is the only one to provide stability and not to be precisely super sensitive to the extremes. At the same time, we need bold reforms, and the agenda has to be bold. And the Prime Minister was right to push some key items of this agenda, and I know that a lot of ministers will advocate for very important reforms from economic, social, and home affairs point of view. But for me, we are just building something. But look at the situation. Nothing was sacrificed. All the reforms are preserved. And this new government has to work with the parliament and progressively will build consensus. So I'm not naive, I'm reasonably optimistic. But I think at the same time, we have to accelerate to deliver a positive EU agenda.
Lars-Henrik, the President has spoken very clearly about how he saw the challenge presented by the fact that you had a third of the population potentially, or voters, voting for the far right. Do you think, I mean, that is obviously an issue here. Do you think it's realistic for the centre to continue to lock out the extremes in European politics?
I think this is a big issue right now also in this country, in Germany. If you look at some of the elections we recently had in the Länder, it's a challenge. But I do think, you know, I'm not a politician, but I do think not having them part of the government to sort of disenchant them or, you know, show how they cannot do it, I think that's the wrong strategy. I think you should not have them being part of the government. I think the government has to deliver. And as you're saying, I think showing to the people that, you know, the growth and the economy and, you know, inflation and healthcare and all these kinds of issues are solved, I think that's the way to get the people to vote for you. Because I don't think in Germany, when it's 30 or more % of the people vote for parties which are very extreme, I don't think these people are very extreme. I think you need to, you know, deliver to them an important agenda and results, and then they will vote for the right thing. So I don't think the strategy, but you're much more of a politician here, to include them and then to show that they can't govern. I don't think that's the right strategy. It's also very risky. I think you need to do a good job as a politician and offer and show to the people that it's a good thing. So I think that's, but I think that's what you were saying as well.
I wanted to get to one of the...
And I should actually say, if I may say so, I was going to say that in my closing statement, that we had a survey by Egon Zehnder surveying business people around the world, what is the biggest challenge for you right now? And the number one challenge was nationalism and populism. So this is clearly also a business concern. So it's not good for the economy, actually, to have these kinds of results. So I think this is actually a very important one.
So one of the ESMT students, the global students, Emma Yagmurova from Kazakhstan, has a question.
Bonjour à tous. Bonjour, Monsieur Macron, Monsieur Rollet, Madame Flander. Yes, as mentioned, my name is Emma. I'm a student here at ESMT, and I'm honored to be part of the Young Voices program. And our question is, with a little lead-in, may you argue that deeper integration within the European Union will strengthen the EU ability to act on the global stage? But at the same time, others fear that it undermines national sovereignty. In this regard, how do you envision balancing further integration within EU and addressing concerns about about national sovereignty?
Thank you very much. By the way, I love your country. Look, I think there is a way to move forward, and this dilemma is very well known, and I think is right. But I think we have to deepen the single market, and we have as well to increase subsidiarity. And this is a way to address this dilemma. When I say we have to deepen single market, energy, for instance, telecom operators, and financial services, if you clearly deepen the single market, because on these three sectors you don't have an actual single market. It was out of the initial perspective. If you build a single market, at the same time, if you alleviate as well the burdens and the over-regulation on healthcare and some other industry, there is almost no impact on normal people, because you just force people to adopt the same regulation. It's a lot of noise, work, and hourful session for a lot of technicians and the industry everywhere in Europe. But there is no impact on the normal life. What makes people crazy with Europe and integration is when just you bother households on their normal life. When you, which is true, but this is a well-known anecdote, but when you force an olive oil producer to be compliant with such a regulation, and when you force to stop this just geographical indication in this part of Italy or France to be compliant with this rule, when you force the hunter in one place not to do it there, but you allow the other one. I mean, this feeling, which is the resentment of some part of our population, to be blocked, disrespected in their way of life by leaders and by Europe, is due to the fact that there is a sort of unadapted approach. We go too much in the nitty-gritty. So for me, we have to stop over-regulating all the details of this way of life and focus on the big issues we have. We have much bigger issues than all this regulation. We did it for good reasons, but now we have to stop and digest. It went too far from a lot of these people. And I can tell you, because I do agree with what you said on the reasons of the far-right vote and nationalism, as you mentioned. Sometimes it's about very tiny things. Just they are fed up with this over-regulation and because they are hurt in their day-to-day life. But it's totally compliant with deepening single market in the critical areas because there is no impact on them. So my point is, let's focus on the big issues. Let's deepen single market on energy, telco, financial services. Let's create an actual single market on AI and hydrogen. It's a super agenda for the years to come. It's already an immense agenda. And let's stop regulating on the nitty-gritty and on the daily life for households. And we will calm down the resentment and the feeling nurturing nationalism, and we will deliver concrete results.
Mr. President, I want to take you right back to the final question. We've run out of time, but from where we started, which was the sense of urgency you had in your remarks, that you felt everybody in Europe should feel about the challenges facing the European growth model. And as you know, often in Europe, it's a moment of crisis. It's when politicians are looking over the ledge that they actually have done things, whether it's the global financial crisis or, as you mentioned, COVID. the invasion of Ukraine. All of those things have forced change. As an economist, I would think that the fact that the EU could be 40% smaller than the US in 20 years' time if it carries on like this is a bit of a crisis, but it's a slow-moving one. Will it take an outside force to force this kind of change? And I wonder in that context, would the return of Donald Trump as president help you get some of this done?
Look, I think it could have consequences of the defense and security part of the agenda, for sure.
Good consequences.
Consequences. But I think we should be, honestly, I don't want to speculate on the US elections. My point, more than that, is that US is a very strong partner. This is a very important ally. But whoever will be elected and whatever the administration is, I think we have to be lucid on our situation. Europe is no more the top priority of the US. The US top priority is US, which is normal and fair. The second top priority is China. And for the rest, it depends on the moment. They are super loyal and reliable partner on Ukraine. Will it last? I don't know. But let's be clear, at the same time, in Afghanistan, we didn't have the call before. And in the AUKUS deal in Australia, I didn't have the call before. But it's not a reproach. I try to be lucid. The EU is not the priority of the US. And this is why part of the wake-up call period of time we are living, and part of what we have to completely reshape, is our defense and security strategy. We are part of NATO, no discussion. We are a strong ally of the US, no discussion. But we have to de-risk our model from the US agenda. This is why we have to invest much more for ourselves. We have to create much more European solutions. We have to preserve much more our financing for European solutions. This is a top priority. But what you said is very important. And this is why I try to be vocal. And we moved under the pressure of crisis when they were perceived by our fellow citizens. The financial crisis and the COVID crisis. You are all here, business leaders, political leaders, intellectual leaders. Our responsibility, your responsibility, our collective responsibility, is to explain our fellow citizens that this is a symmetric shock for Europe. They don't see now the results and the consequences. But our responsibility is to preempt the situation and to act now. Otherwise, it will be a rescue plan in 5 to 10 years' time. It will be awkward. And we know the situation. The figures are clear. The trends are very clear. So our responsibility as leaders is precisely to say, okay, we feel the pressure. And for me, Europe can make smart move when we have symmetric shock. During the financial crisis, don't overestimate, we did react, but we didn't take automatically all the right decisions because it was an asymmetric shock. And we fixed this crisis much more slowly than the US because we were precisely divided between North and South. It was a weakness. It was before banking union and such a level of integration. But it was an asymmetric shock, meaning we didn't have the same interest. Today we can have in the nitty-gritty some different interests. You are much more invested in car-making business, fine, which creates this kind of discrepancy. But in reality, we are already aligned because it's already too late, if I'm fair. It's already too late. So we should be aligned and just look at the situation. Whatever our differences in the energy system could be or industrial system, this is a symmetric shock for the European societies and economies. So we have to precisely deliver this in-depth reform on our governance, on security and defense, and the growth model, if just we want to deliver for our people. And this is the best way, by the way, to help all the countries precisely to limit and get rid of the extremes, because they are just held by the resentment of people and the lack of collective efficiency.
Ladies and gentlemen, you've had your marching orders from Mr. President, and I think we've run out of time. So thank you very much, Mr. President. And Lars Henrik, I think you're going to
Thank you very much.
All right, you've been listening to an exclusive conversation with French President Emmanuel Macron at the Berlin Global Dialogue event hosted by our own Stephanie Flanders. Interesting comments there at the end, of course, about the relationship with the U.S. Macron saying that he doesn't know if the U.S. is to remain a reliable partner on Ukraine. He also said that it's clear that the EU is not the priority of the U.S. and that, as such, they have to de-risk our model from the U.S. agenda. Fascinating stuff there. Meanwhile, let's turn our attention back to U.S. markets there because there's a lot of action underway, a bit of a reversal underway. If you take a look at the S&P 500, now back to unchanged territory. We briefly went positive, of course, nipping there right now. You take a look at the NASDAQ 100, your big tech names already there, back in the green. The NASDAQ 100 currently up about 0.2%, and even the small caps putting in a good fight here, currently up about 0.1%. Let's look cross-asset as well because that's where a lot of the action has been. The 10-year yield currently still higher by about 7 basis points. The bond market holding on to its losses, not really benefiting from that haven bid that you may have seen in gold and in the bond market yesterday. New York crude, meanwhile, continues to climb higher, up about 2.6%. We're trading just below $72, of course, not near the recent heights above $80, but a climb higher. And then you take a look at the VIX, a little bit of volatility coming out of this market, currently trading with a 19 handle on the VIX.
Interesting. Brent still at 75. And that brings us to a deeper conversations about the markets. We are joined now by Racquel Oden. She is HSBC Head of Wealth and Personal Banking. And over the last couple of days, you really saw that fear enter the market with rising geopolitical tensions in the Middle East. And energy has been the gainer in this market when you see fear starting to enter the atmosphere. But do you buy that story? You are seeing a rise in oil prices, but is that enough to sustain the energy sector?
Yes. So I think as you think about the sectors that matter, you also mentioned technology, really critical. As we think about the tech sector, I think we know that stays really strong. We take a look at the Magnificent Seven, continues, as you just said, are back to their heights. But what's really exciting about that sector right now for us really is the widening of that sector. I call it the forgotten 493. As you take a look at the Magnificent Seven, they've peaked at very large highs, but there's opportunity of another 493 to broaden out that tech sector. And then secondly, you're absolutely right. I take a look at utilities, specifically in energy. I'm going to put them together. Clearly with what we just saw this morning that we woke up to the Middle East crisis, right, that continues to give us some concern, so that will have impact on our oil prices. But utilities, at the end of the day, again, is going to be very highly fueled by the fact that we still need that core energy, but it really is the manufacturing, and it's really what I call fueling the data centers. Yeah. And so I'd add the third one, which I think is also important, is healthcare, the health sector. And the reason why that is the analogy that I would use between tech, utilities, and health, they're all truly going to see growth, and what I'd say strong picks, because underpinning all of it is AI. And so that's going to be really critical if we think about the growth of these sectors as we talk about where you should be focusing in this environment with a lot of uncertainty and all these things happening, with the rate cuts coming, where should you be focused on? And then the fourth one I'd probably put in there is financials, the finance. And if you take a look at the S&P, the Dow, you just talked about it. We look at corporate earnings, they've done extremely well, 10% this year, probably projecting another 15% for next year, which really is a good sign for IPO market and M&A. Right. And so, I'll throw the fourth one in there, which is, financials, because we do really have a healthy market, which really says with the continuation of the rate cuts, really a big opportunity for M&A and IPOs.
So there's a lot to dig into there. I want to go back to what you were saying, though, about AI, because I understand the AI connection to utilities. Of course, it's one of the favored avenues right now. But were you saying that healthcare, too, a beneficiary? We don't hear often about that. Walk us through it.
So that's really what we call, I'd say, the biotech component of health. And I think very importantly, if you take a look at how they are fueling the health anticipation of future, it really is leveraging the AI to really feed that. And so what's incredible about AI and across all those sectors that I just mentioned, we're just at the early innings of it, right? And so when you talk about the tech sector as a whole and how it's impacting all sectors, the future is bright. Now, We still have to balance regulation and making sure we're doing it in a smart way, but it really fuels the growth across multiple sectors, but specifically, obviously, with the biotech and within the health sector.
I think that's such an important differentiation because we were talking about it a little earlier, kind of that focus on pharmacy, on big tech, on drug pricing. Does that mean kind of, you think about those small and mid caps, is that where to look for healthcare names at the end of the day?
Yeah. I think, I don't want to say that we've underestimated the importance of how health will actually benefit from technology and AI. But I think that's what I call the secret benefit that we haven't been talking about enough so that people really understand why that sector is going to do really well. If you take a look at healthcare, they're saying it actually might outpace tech next year. So it really is on the rise for the exact reasons we talked about, underpinned by tech and AI.
That's really interesting, the idea that health could outperform tech. If one of the sort of...
Fueled by tech, though.
Well, that's
Fueled
the
by
thing.
tech.
I mean, it feels like everything in this market is somehow connected to that AI narrative, that you can't really get away from tech, even as you look for winners. But I do want to build on what you're saying when it comes to healthcare and AI, because we often hear when we talk to investors, when we talk to strategists, that it's too early to pick winners on the application side, that it's safer to be in sort of the picks and shovels right now. But how are you evaluating the potential winners of that disruption in a positive way?
So I think the way versus picking the winners, that's the point I'm trying to make, is the sectors that are going to be fueled by AI. So the subtlety that I would say that I think is really important is when a recent study that was just done that shows companies that have, well, 91% of all tech companies have AI as part of their core philosophy and working within the system. The second piece that I thought was really important about that is companies that have leveraged AI are seeing close to a 12.5% increase in their earnings versus companies that have not embraced AI closer to more 8%. That gap is going to continue to widen. And so the importance of AI in every sector is really going to be a fueling engine. So I always say lean to the sectors that are embracing AI and allowing the benefits to what I'd say be more of a long-term horizon. But again, you're right. We're truly at the beginning innings of AI. So there's so much more to come.
Racquel, we have to leave it there. We have to have you back soon. Really appreciate your flexibility today. That, of course, is Racquel Oden, HSBC Head of Wealth and Personal Banking. Really fascinating comments on AI. Meanwhile, let's pivot here and let's turn to the race for the White House. The general election a mere 34 days away. And meanwhile, the candidates are straddling multiple geopolitical events, including increasing conflicts in the Middle East and a port strike that's paralyzing the East and Gulf coasts. Terry Haines, he is Pangaea Policy founder. He's here with more insight, of course. And when you think about the fact that we are 34 days away, we, of course, had the vice presidential debate last night, potentially the last debate of this cycle. I mean, how much do polls matter here? How much can we actually glean from the polls and what they're saying, given that we're still within a margin of error?
Good morning, Katie. Largely what you can glean from polls is that the race is neck and neck, that there are very few swing states that are crucial here, and that and this is all going to come out to turnout, and that's a kind of a standard response. But what really matters in this race is who's the most enthusiastic about the candidate, who's most likely to reach across the aisle and be able to get some undecided voters. And right now I think Harris remains 60% likely to win, but in a split political Washington that shaves off some of the more progressive edges.
Terry, I also want to broaden the atmosphere here to talk a little bit about what's happening in New York, because there were additional headlines coming out this morning about Eric Adams, the idea that he may be charged with additional counts according to the U.S., and that more defendants in the case are quite likely. What are the broader implications of this, especially for the Democratic Party?
Well, I think what happens in New York largely stays in New York. New York is key to the elections this fall in one sense, that the likeliest path to a tiny majority in a Democratic House for the Democrats is being able to pick up some of the seats in New York that they lost to Republicans in 2022. That's always been a big part of the strategy. I imagine that still continues. People will look negatively and look strangely at what's going on with Mayor Adams and other senior folks in the New York government, in the New York City government. But beyond that, I don't think it has a huge impact. The National Democratic Party has been working on, kind of getting blue turnout maximized in the fall, and I think they'll probably do some of that.
All right, what happens in New York stays in New York. We'll have to write that one down. Let's talk a little bit more, though, about the election. Again, 34 days away. And there's the narrative out there that, of course, U.S. voters vote on U.S. issues. They're chiefly concerned with the economy, that foreign policy isn't necessarily what they're thinking of in the ballot box. But when you have sort of these geopolitical episodes that we're experiencing right now, especially in the Middle East, does that common wisdom change?
I don't think it changes a whole lot. It's interesting. You think about what voters talk about as their lead issues, starting with the economy, and you think about the questions that got answered last night by the vice presidential candidates, and you see a real split between what the most important issues are to voters and what these candidates think motivates voters the most to go to the ballot box. In this case, what you saw, I think, particularly from Governor Walz, but also from Senator Vance, was a focus on social issues. And Democrats are clearly relying on two things. First, social issues, and secondly, Trump loathing, to get people to the ballot box and put Harris over the top. And Vance, at the same time, wanted to talk about the economy a lot, did to some extent, but at the same time, frankly, was apologetic to folks about some of the stands that Republicans took, saying that Republicans have to do a better job of explaining and listening. So what you had was a much more skewed social debate, and that indicates that the candidates, at least in the campaigns, think that the economic views are baked in to some extent. In other words, people already think what they think.
Terry, we thank you so much for your time. Of course, a lot of rhetoric. Let's see how much it actually moves the needle at the end of the day. Looking forward to that drumbeat to the election. That is Pangaea Policy Founder. Stick with us. More markets ahead. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And as generative AI use continues to grow, so does the need for computing resources. David Weston spoke with CyrusOne CEO Eric Schwartz about the growing demand for data centers to manage all these new applications.
Right now we have 58 data centers, but we have several under construction. So by the end of the year, we should be north of 60.
What is accounting for the pace of the construction of data centers? It seems like it's really consumed everybody's attention in the last few months.
So technology is all around us, and that technology requires compute capabilities and capacity. And so as we hear and build more data centers, that capacity is supporting the technology that we all use in various ways. So think about e-commerce and all of the goods that move and are purchased online. Think about social media, or even think about more scientific pursuits like modeling a vaccine. All of those things require tremendous amounts of compute resources, and those resources ultimately get housed and supported in data centers like the one we're sitting in.
There's a lot of talk about generative AI right now, particularly since ChatGPT came along. There was machine learning and AI before that. Have you seen a marked increase in the demand and attention given to data centers since ChatGPT?
Absolutely. So with the advent of ChatGPT, that has taken artificial intelligence demand and requirements to a whole order of magnitude increase. And the models that run behind ChatGPT and that support artificial intelligence in many ways require intense amounts of compute capability. And so that is driving us and other companies to build even more data center capacity to house those resources and to support these new applications here in the US initially, but eventually around the world.
Talk to us about the capital investment required for these data centers, if not in specifics, in general terms. We're seeing right now, for example, some of the hyperscalers saying they're spending a lot of money in capital investment right now. A lot of it's going, I suspect, to places like CyrusOne. What is the level of, in general, the level of capital investment required? And who's willing to put up that money for a good long time?
So these facilities are extremely expensive to build. It takes a substantial amount of capital. Current estimates would say that the annual investment in data centers is far in excess of billions of dollars a year. That capital, in part, comes from the hyperscaler users themselves, but then it also comes from a variety of investment sources. CyrusOne, in particular, has lead investors as KKR and global infrastructure partners, and that's an essential part of what we do because we need the volumes of capital to be able to keep up with the demand that we're seeing from our customers.
And that was CyrusOne CEO Eric Schwartz speaking to our own David Weston. And of course, you can catch Wall Street Week every Friday at 6 p.m. Eastern. Meanwhile, let's take a look at these equity markets about 90 minutes into the U.S. trading day. Interesting here, a little bit of a reversal. The S&P 500 struggling to go green right now. Of course, it had been down 3/4%, currently down about 0.1%, looking at unchanged territory. You take a look at the NASDAQ 100, you are seeing some green. Of course, the NASDAQ 100, your big tech names, currently up about 0.1%, trying to recover a little bit of the losses that we saw yesterday. Meanwhile, small caps, your biggest winner right now is those small companies, the Russell 2000, currently up about 0.2%. You take a look at what sectors are doing well right now. Energy, as you would expect, the energy sector currently up about 0.7% as oil continues to climb. Then you take a look, you have big tech doing well, materials. What's not doing too well right now, Sonali, as you might expect, it's consumer discretionary, it's real estate, and it's staples, also down about 0.7%.
We'll bring you some of those stocks moving under the hood as we head to break. Nike really wiping the slate clean for its incoming CEO, Elliott Hill, and it's pulling its full-year sales guidance ahead of its arrival. His arrival shares, though, still down more than 6%. Humana, it looks tough. It's about 15% lower, but remember, it was more than 23% lower, so you are looking at a little bit of relief relative to where we were before. Bright side, Tesla is down almost 5% still after missing on EV third quarter deliveries here. They were slightly behind the average analyst estimate, but of course, a lot of worries about what EV sales look like this year.
Yeah, and I mean, Tesla, of course, it's its own unique special animal. It tends to trade on the whims, the tweets of Elon Musk, but certainly when you miss on deliveries, you're going to see that reaction.
China not saving Tesla today. Now, coming up tomorrow on Open Interest, we're going to talk to Michelle Gass. She is the Levi Strauss CEO. We're going to talk about jeans and Beyonce, if you could believe that, in the C-suite. Stick with us for that. This is Bloomberg.